As we start out on the month of December, a lot of the anecdotal commentary about where we go in the month is all about the much lauded Santa Claus rally. Is it fact or is it fiction? Let's catch up now with a technical view of what we could expect this year in 2023 as we go into the meat of December. Ron William from RW Advisory joins us now. Ron, welcome. I want to take a look at what a Santa Claus rally is in just a minute, but let's just quickly ask you, first of all, to give us the setup, the backdrop, where we are, what's happened, and as we go into December, what should we be looking for?
Well, season's greetings, Jeremy. Good to be back engaging with each other on markets in the UK. The Santa Claus rally is fact, just to give the headline answer first. And statistically, we'll take a look at to how advantageous it can be to trade this from a tactical perspective. However, this year, market backdrop and behavioral and cycle indicators suggest that the Santa Claus rally will likely be muted because Santa has likely visited earlier this year in terms of the discounted Black Friday weekend that we just enjoyed. And so the best is likely already done.
Okay, well, let's take a look at your first chart and we can get a better idea about what it is you're looking at. You've got here the global ranking model. As I say, this gives a little bit of a backdrop to what's happening in the short term, medium term, and the longer term strategic view of the markets. Just talk us through what this is telling us and how we should interpret it.
Yes, well, this is looking at the global cross-asset ranking model. And as you just mentioned there, from left to right, we have the strategic long-term, tactical medium-term, and active short-term trend filters. And what it shows is that there's been a broad tactical surge in risk proxies, notably world equities, Bitcoin, and gold. And just to preface the last two, that's a little bit of risk on, but also risk off in terms of some of the geopolitical headwind that has taken place in recent weeks. Now, US equities has been led by growth stocks, but also year-to-date laggards. From a macro perspective, this is post-interest rate unwind from that 5% historical level, and the so-called Fed silent pivot, where it became less hawkish than the last year or so. Looking at the chart on the right, figure 2, we can see the S&P 500 blow-off rally measured historically cross-asset performance surging up from November onwards. And the actual momentum gain in the bottom right-hand chart, figure 3, was the best rally of this year, only comparable to Q4 of 2022, the year prior. And essentially, that's a post 3-month drawdown. So remember, we had the top in July and then the sideways volatile environment that followed. So a bounce, sharp bounce from oversold conditions was expected, particularly during the positive November seasonality trends that we discussed last time on this topic.
Okay, let's now go back to that opening question and ask you just what the Santa Claus rally is, because it's not, I don't think, necessarily got it set in stone as to what it is and when it starts, when it finishes. But what's your interpretation of just what it is?
It's a seasonal pattern, great for tactical timing or portfolio repositioning. And essentially, it is driven by sentiment. There is a holiday-inspired buying bias at the back end of December, not the whole of the month, but the back end of December into early New Year. And we can see on this follow-up chart the statistics evidence-based approach, backtesting market performance into this time window. That includes various US equity markets, growth and tech driven, as well as the pre-election year performance, of course, as we go into the election year of 2024. And it just shows that the average Santa Claus rally upswing is about plus 1.3% during that time. The disclaimer I would add here is, of course, this works most of the time, but not all of the time. Like all things, there is no holy grail or one size fits all. And so there are times when this signal is either muted or failed. And those historical rhymes I've highlighted on the right, that's whenever markets are flat or in an early to mid-stage bear market. And that was in the year of 2000, tech boom bubble crash, 2008, global financial crisis. And then, of course, last year, as part of that transition, 2021, I should say, late 2021 into early 2022, where most asset classes underperformed. Now, I do want to quote the well-known saying of Hirsch, who developed these seasonality patterns back in the 60s behind the Almanac book series. And he said, if Santa Claus should fail to call, bears will come to Broad and Wall, as in the broad market or Wall Street in terms of the blue chip sector.
Yeah, of course, very famous set of books, the Almanac for the US markets, Jeffrey Hirsch, as you were saying. With that, let me just follow up in some more context about what this entails.
Yes, so what it entails, more to the early side of the question, is essentially the positive sentiment into year end. That's the most intuitive driver behind this signal, but also from a portfolio management perspective, year-end restructuring or window dressing of the portfolio as people want to report best returns into that period. And then there's also reports about post-weaker tax loss selling in the first half of December, which then also adds further support. So it's a combination of each of those factors, but first and foremost, that positive sentiment into year-end that often happens.
Explain more about what's going on this chart that you've got here, because you talk about the S&P 500, this rally that we've seen. And as you said earlier, could it be that we've already had Santa's visit a little bit earlier than otherwise might have been the case? We don't know yet how the month is going to develop, but explain more about what's happening here, because we've broken that 2021 bear trend line.
Yes, so the good news is that Santa has visited already, and so many of us should be grateful for the portfolio presence that we've received in terms of the record surge in the equity markets not seen since last year. But of course, what that does mean is that markets don't move in a straight line. They often zigzag. And in this case, price momentum has become overbought. According to the chart itself, you can see it's looking very unsustainable, and there were multiple exhaustion gaps along the way. So you have that kind of unsustainable acceleration. That pushed up to about +2 standard deviation according to the dead score measure. And then finally, in terms of overhead pressure, there's the long-term trend line, which some people may be aware of. You have to go back to the peak highs of 2021 into 2022. And if you connect that peak with the July peak, that is literally slicing through the price action right here and now and creating some pressure. So it's a combination of overbought market with overhead price resistance. So that's the price side of the equation into time risk windows. And that's what I've highlighted both on the chart in terms of time factor short-term windows during the month of December. But also if you see the chart in the middle on the right, the cycle model developed by Foundation Study of Cycles, suggesting downside risk according to the rhythm of the market now going into the new year.
Bottom right-hand corner I find really fascinating. If we go back to this, you can get some projections. I think you put down on here for some of the big banks. Some of these seem really quite toppy. When were these given, these trends, and what's your thought on some of the numbers that are given there?
Yeah, so as part of the behavioral sentiment work, I'm always keen to see what some of the smartest minds in our industry are forecasting, particularly when there has been a surprise move, because that tends to lead to the biggest and best risk-reward opportunities. Now, this latest record rally that we've had did catch most by surprise. I was expecting it myself, but not to this extent, and others maybe less so. So once the move was in, a lot of year-end forecasts were revised to the upside to price in that linear extrapolation. So you can see here the most bullish of them all, just to cite some names, and this will be published in public sphere. Deutsche Bank, BMO, looking for 5,200. Bank of America, RBC, looking for 5,000. So there's been a big shift, not just up, but up to roundabout level 5,000 plus. And then the median level, Goldman Sachs, Societe Generale at 4,750, 4,800. And on the bear case side, still believing that this is a bear market rally, Morgan Stanley and Barclays at 4,500.
Okay, let's bring it all together then and take a look in some more detail about how we can assess this. Your next chart talks about comparisons to the S&P 500. S&P 500, of course, now, as we know, is split into tech. A lot of tech companies now in the S&P 500, a lot of non-tech companies as well. How do the comparisons work with the market against the S&P 500?
So this has been an ongoing theme that many experts, including myself, have discussed, and we've paid some attention to this, Jeremy, you and I, during previous discussion. There's extreme market concentration. This actually began early this year, so it's not new, but it is very unusual and concerning that it has lasted for as long as it has. So it's really interesting to go back into history and to look to past market analogs where this has happened before, just to see what that anomaly might mean, but also if there is an asymmetric risk built into that, which I believe remains, how far can the elastic band stretch? So if we look at the chart here, main one on the left, developed by Bloomberg, this shows both the FANG and the Magnificent Seven return performance versus the rest of the S&P 500s. And basically what it shows is that concentration risk based on the growth tech sector has not been this overextended since the 2000 bubble phase. So certainly something of concern. There are some people saying, well, hey, maybe this time is different, perhaps in terms of some of the new innovative and disruptive technologies out there. But as we discussed sometime this summer, the perils of painting the tape. Tactically speaking, in the short term, this type of price action and lack of rotation and breadth usually creates a snapback in the elastic band, which only then can recover once we've had a shakeout. Now, looking at the S&P 500 index equal weighted, so if we strip out the market cap weighting of tech and any sector that's over influenced, we can see that border and equal weighted indices remain flat on the year with elevated volatility. And the recent rally that we've had for the month of November is just above the historical mean for this year. That's the chart on the right.
So, bringing it all together, what is the assessment? We've had the rally, now the market falters. As we go into election year, what's your summary of how we should interpret all this data?
A good opportunity to lock in profits and hedge downside risk from a positioning perspective. For those who are brave enough to hedge or short, then that might be another follow-up strategy. But what I would say is continue to stay on your toes, perhaps consider a barbell strategy where you are still trading the markets that are popping to the upside, but be very aware of overall conditions where we are right now, muted seasonal patterns like the Santa Claus rally, which will likely not happen as expected this year, or perhaps has already been priced in terms of the gains we've seen. And then going into the new year, be vigilant for how we start that year, given the backdrop that we've just discussed.
Okay, look, Ron, thanks so much indeed for joining us. It's been a pleasure to catch up with you on the Santa Claus rally. That's Ron William from RW Advisory, taking a look at market performance up to December, where we've already been given or blessed with an enormous upside that was unexpected earlier on this year, with one of the best months we've seen in many of the markets in the Western world. The big question is can it continue into December? Probably not, because it's already been. That's Ron William from RW Advisory.